Okay, we'll go ahead and get started. Thank you for joining us. Again, this is the March Market Outlook from Blockchain.com, and I'll be your host and MC today. I'm Jason Karch, the VP of Marketing at Blockchain.com. I'm subbing in for our co-founder and Vice Chairman, Nick Carey, who is out due to an accident. He's fine, but recovering. Regardless, let's talk a little bit about Blockchain.com first, so you know who we are before we get into today. So we're Blockchain.com, and we've been around since 2011. Many of you may remember us as Blockchain.info, one of the first and most widely used block explorers, still one of the most widely used block explorers to this day. We've, over the past 10 years, gone from 2 wallets to over 65 million wallets created worldwide, over $800 billion worth of crypto transacted over our networks. And we are in over 200 countries. So a truly global blockchain first company. And as you can tell, we've renamed as Blockchain.com. Fun story, we started as Blockchain.info and we bought the URL for Blockchain.com at the same time, but we just switched over. We thought .info was cooler. It turns out .com had more staying power. But in terms of how consumers know us, you probably know us for our wallet. We've, in the last 2 years, launched an exchange, which has about 40 trading pairs, including 4 different fiat on-ramps, a block explorer, and we've also had a lending business. So for both institutions and for retail customers, we offer yield if you deposit crypto with us and borrowing opportunities. And finally, we make it really easy to buy and sell crypto. So with that, why don't we take a look at what we've shipped recently, because it wouldn't be a company-sponsored event if we didn't plug our own products. But we launched a faster crypto simple swap experience in the wallet where there's a custodial to custodial swap. It's cheaper, it's faster, it's easier. If you like using your Bitcoin or your Ethereum to swap into some of the altcoins, that's a great way to do it. We've also launched a wrapped version of digital gold on the exchange in the wallet, which is an ERC20 token that is backed by digital gold, DGLD, the token, which is actually backed by physical gold held in vaults in Switzerland. Our Bitcoin Cash and Stellar interest accounts are live. And right now you can earn up to 7.5% annual yield on those interest accounts and up to 13% on stable coins, so USD Tether, as well as Pax USD. The Simple Buy widget on the Blockchain Explorer is going great. We've rolled out interest to Android, and we've made a simpler checkout flow on the exchange if you want all the tools of an exchange, but a simpler order book purchase program. And we always have to plug our podcast, because last year we launched a podcast. This event will be on a podcast, and we have plenty more episodes for you to check out, whether that's our conversation with Anthony Scaramucci, a deep dive into crypto lending, or a look at why exchanges go down. In terms of the overall, last month, we covered a few topics. So we covered why exchanges go down. We covered a market outlook for January, which was obviously a very strong month. February, also even stronger. We keep seeing new all-time highs. And we, as always, did on-chain insights. Lewis Tuff, our VP of engineering, joined to talk about why crypto exchanges go down. You always hear the crypto equivalent of a fail whale whenever the price spikes or plummets. And it's always very confusing to understand why that happens. I would check that out on YouTube or in our podcast. But today, let's talk a little bit about what we'll be talking about. So we'll talk about February markets. We'll talk about the on-chain insights that we garner month over month. And our special guest today is Ambre Soubrian, who is the CEO of Kaiko, a technology company providing market data to the digital asset space, currently covering all traded pairs across 100+ exchanges distributed all over the world. So she'll talk about their data, perhaps the markets, and also some inside baseball about being a CEO in a crypto data company at this time. So without further ado, I'll hand it over to Garrick Heilman, who is our head of research, and will take a look at the market.
Great. Thanks so much, Jason. So yeah, as Jason mentioned, February was an incredible month for Bitcoin in particular. Everything moves so fast. It feels like a year ago almost that Elon Musk made news with his big purchase, but that all happened not too long ago. We saw another new all-time high up around 58,000 in February. For the month, Bitcoin finished up 36%. Eclipsing Ethereum's almost 8% gain for the month. And you can see year to date, both are powering higher from an incredible 2020, Bitcoin up 56%, Ethereum up 91% already for 2021, and both up roughly about 1,000% over the last 2 years. So I think also we really want to talk about gold and the bonds and what's happening in kind of the broader markets. Gold is frankly plummeting, down 6% in February. That doesn't seem like probably a big move for folks who are well versed in crypto volatility, but that's a big move for gold for the month. And some of that might be explained by the fact that the dollar is showing some firmness. It had its second consecutive month where it eked out a gain, a slightly lower gain this month, up 0.3% compared to last month's 0.7%. And yields rising with the sell-off in bonds. We also saw the long bond ETF, TLT, drop almost 6%. That's another huge move. And some weird liquidity issues going on in the bond market, by the way, where we're seeing some gaps open up between bid and ask spreads that we typically don't see. That story of yields rising, the dollar firming up, that could explain some of the move in gold. We think also, though, there's a growing recognition that, frankly, Bitcoin is a better version of gold. We've talked a lot about that. And we think people are rotating some of their gold portfolio into crypto assets like Bitcoin. That narrative has really solidified in our view. And once that narrative solidifies and you look at what gold is valued at, roughly 10 trillion for all above ground gold, 2.5 trillion roughly estimated of tradable or investable gold, and Bitcoin back below 1 trillion. I mean, that's a really compelling valuation proposition for anyone looking to invest in Bitcoin. And we try to keep things simple here at Blockchain.com. We try to make it easy for people. When people ask us, what's your valuation take on Bitcoin? I think it's really, it's simple as that. Look, Bitcoin's worth less than 1 trillion. Investable gold's over 2.5 trillion, and total gold is 10 trillion. That's a nice kind of position, I think, for Bitcoin to be in from an upside perspective, especially when you think about, as we've talked about, for years, all the added functionality of Bitcoin vis-a-vis gold. It's easier to store, verify, slice and dice into smaller quantities, send over space and time much more quickly, and be used for completely non-monetary use cases. Like one of my favorites to highlight is the Microsoft Digital Identity project that's starting to get some real traction that anchors to Bitcoin's network security. That's not something you can use gold for. So right now, we think Bitcoin's in a really strong position for continued gains. We think it's going to continue to converge on the overall value of gold. And frankly, we think it's got much more upside potential and shouldn't be thought of as just digital gold. So we had the Coinbase S1 released. Coinbase is doing a direct listing. This is a huge catalyst for the crypto markets. A lot of people have had a hard time wrapping their heads around a new monetary asset like crypto, but a company with a profit and loss statement, that's generating user growth and more traditional corporate metrics. That's going to, I think, really bring a lot of investors into the crypto space that have kind of been on the sidelines, wondering about, is Bitcoin a commodity? Is it a currency? What is it exactly? And one of the interesting data points in the Coinbase S1 filing was this comparison with Q4 2020 and Q1 2018, which was the tail end of the last bull market. And you can see that their data really strongly shows that retail trading, the small investors, really were dominant back in the last bull market, 2017, 2018, but that's flipped. Still strong retail participation, but institutional is actually making up more of the trading volume then. And we think that's actually a really, really positive, healthy sign for kind of the upside potential for the space. Institutions sit on the vast majority of capital, and the fact that they're engaging and owning crypto is, I think, really important for the continuation of the growth and the market value of this sector. The other thing we wanted to talk about before we turn to our on-chain insights is our investment thesis. It's coming up in 2 years since we published our general crypto investment thesis titled Trust, Want, and Need, 3 key dimensions of crypto asset adoption. And we thought, with Bitcoin setting a new record high, Ethereum cracking 2,000, what is the state of our investment thesis? How has it held up over these last almost 2 years? And so we want to look at these 3 dimensions: trust, want, and need. How is crypto doing across these three dimensions? There's been surveys done by the New York Fed, for example, that showed that crypto is often perceived as deficient in some of these areas, trust and need in particular. So let's start with the need. We think this is where actually crypto in the last 2 years has probably made the strongest inroads, with just this week, banks in Germany telling customers to take their deposits elsewhere. We don't want you to deposit your money here at German banks. I mean, this is incredible. You have negative interest rates really forcing banks to turn customers away, while at the same time in the crypto space, you have double-digit interest rates offered on savings deposit, US dollars, available at companies like Blockchain.com. At the same time, the digital gold story around Bitcoin is driven by concerns around inflation, high levels of debt. So the need for crypto, I think, is where we've seen the most improvement in the last 2 years. That need is becoming more and more clear to corporates, to Wall Street, and to retail as well. On the trust side of things, I think it's a little more fuzzy. I'm reminded of this famous clip from 1994, before the internet was something we were all familiar with and knew how to use. The Today Show, an American television program, had their host kind of, what is this internet thing? People were confused, not really trusting what the internet was back then, similar to how in the early days of crypto, we saw a lot of confusion and maybe a lack of trust, especially with all the news about exchanges being hacked. We've seen a lot of progress in security. That's helped, I think, with trust. We just actually, Blockchain.com did a security awareness week. There's still a lot of work to be done there on the trust side. And also, if you get into the DeFi sector, there's still a lot of rug pulls, as it's referred to, evaporation of liquidity, and we can talk with Ombre about that, and various other kind of 2017-esque kind of pumps going on with DeFi tokens that may be eroding some trust. But in general, we think the institutionalization, the regulatory clarity, the improvements in security, these have all really helped us move the needle in a positive way on trust in the last 2 years. To wrap up on the thesis with the want question, that's actually where we think there's been the hardest and really the most work still to be done is around creating a desire and want for people to own crypto. And this is something we could write a very long essay about, or lots of essays. What is it that's kind of kept crypto to be only held by roughly 100 million, maybe 150 million people around the world, roughly? It's complicated, right? Some of it may be due to concerns about Bitcoin's energy consumption and carbon footprint. Volatility, it's stressful for a lot of people. They don't want to deal with an asset that's this volatile, or they're concerned about how to value it, especially, some of these ghost chains that are pumping, Dogecoin, for example. They don't have a lot of real economic activity, yet the price is going, crazy due to tweets from famous personas. You've got, still, a lot of like, oh, crypto is only for the bad guys. Janet Yellen, the Treasury Secretary, highlighted this in her testimony. And, as you dig deeper into these issues, I mean, I think concerns start to be alleviated. We think actually Bitcoin and crypto can be a net positive from an environmental perspective over time. Crime is a tiny percentage of actual crypto use today. But there are still reasons behind why people don't want to own crypto, including the simple fact that inertia and human tendency to not want to change keeps people on the sidelines. So in other words, we think this want area is really, I think, one of the biggest opportunities for crypto asset adoption, and where we as an industry still need to do a lot of work. Okay, so let's turn quickly to Bitcoin on-chain insights before we get to our discussion with Kaiko's CEO. So, real quickly, average Bitcoin transaction fees nearly doubled last month to $21 a transaction, possibly denting retail activity. Institutions can afford $21 a transaction on the Bitcoin network or comparable fees on Ethereum. They're moving much larger sums of money around, and so that fee doesn't make as much of a problem for those folks. But obviously for smaller retail investors, this does pose an issue. And we saw that actually in our Blockchain.com company market share of Bitcoin transactions dropping for the month from all Bitcoin transactions using Blockchain.com, 35% in January down to 33%, a 4.2% decrease, and also a drop in payments. Remember, are actually packageable within a single transaction. We'll talk more about that in a second. 11% drop from last month for Blockchain.com's market share. But this transactional efficiency story, I think, is really important and something that gets lost, especially in this energy debate about Bitcoin's energy footprint. We see the payments increasing dramatically on network while transaction levels are staying rather steady. And that's not something that's often talked about by people criticizing, Bitcoin's efficiency. It is becoming a lot more efficient. We are seeing better use of batching and bundling of payments into single transactions. And so this story is not being told well enough in the public, and it's something we're going to be working to try to communicate more publicly going forward as well. Last, in terms of our on-chain insights, we want to talk about the mempool. The mempools, for those not familiar with this, is kind of like the holding tank of Bitcoin transactions that are waiting to be added to a block and verified in the permanent ledger. And this holding tank is actually really important for why Bitcoin, for example, had perfect uptime last month while the Fed suffered a major downtime incident where ACH and a lot of the Fed wire and payment rails that the Federal Reserve System operates failed. Bitcoin's got incredible uptime. We analyzed kind of when it's, you have the highest amount of traffic, so to speak. And it's actually Sunday is the best time when you see the least amount of traffic. For those of you who have some flexibility on when you make payments, Sunday is a particularly good time to actually make a payment. And also the early morning hours, London time, tend to be also very good times for making payments. So we write more about this in our monthly Outlook, the blog. So check out that blog piece for more details on our on-chain analysis. And with that, we turn to our conversation with Ombre, who we're very delighted to have, my good friend from France. Let me just stop sharing my screen so we can see everyone here. Welcome.
Hello, thank you very much. Thanks for having me.
It's a real pleasure. We feature your content regularly in our monthly blog, like we are doing again this month. So Kaiko publishes some fantastic research of their own. It's another good reason to check out our monthly blog, to read their latest monthly outlook, as well as go to Kaiko's website. But yeah, it's great to have you. And I guess the typical question we start off with is, for our guests, is how did you make your first euro, I guess, or buck, or I don't know what currency it was, but for an international jet setter like yourself, tell us about your first income.
So sterling, pounds. I started before crypto in the early days. I started working for HSBC. I started off as a young intern there, and then ended up staying a little bit too long, almost a decade. 8 years in Canary Wharf kind of kills your soul, I think, after a while. But my first buck was made as an intern at HSBC on the equity derivative structuring desk. And it was about 2 weeks before the subprime crisis and before the international collapse of global finance. So the perfect way to start as a young, ambitious intern and to, you know, end up with clients literally in tears on the phone because we had sold, well, equity derivatives with, for those familiar, is like you have some kind of triggering events when a specific stock price goes below the threshold. And obviously, some companies did lose a lot of their value at that point, and it was a bit of a hectic times where all the volatility was going haywire and none of the systems and frameworks were working anymore. It was a very interesting time, yeah, so that's how I started working and stayed there until I did the full-time move to crypto.
Cool. Well, yeah, let's talk about that and how you first learned about crypto and you know, did your experience in Canary Wharf, you know, kind of shape your interest, influence your interest in crypto, and then of course, you know, what led to the creation of Kaiko specifically?
Yeah, absolutely. So in terms of just context and background, like I studied applied math and computer science, so I was interested in general with these kinds of like you know, computer and mathematical ideas. I started working in finance because I wanted to earn a living. That was, to be very, very frank, like one of the first drivers for going into finance was I perceived that as a way to make money. And second, trading environment and derivatives environments also I thought was creative and exciting. Turns out not as creative as I wish. Unfortunately, large banks are crumbling under regulation, and it's very hard to be innovative in the space anymore. There's more kind of downside for messing up than upside for potentially thinking outside of the box now. That's probably for another debate, you know, around what startups are allowed to do versus banks, and why also it's harder for banks to innovate, like, period. But that's not the subject. So I started working in crypto, honestly loved my job, loved my teams, and actually a lot of my former colleagues are actually investors in Kaiko today, so we still have great relationships. But I was reading on the side and I stumbled upon the Bitcoin white paper back in 2012 and started reading about that, attended some meetups in London. I don't know, Derek, maybe you were part of that like early crowd of weird Brick Lane underground Bitcoin meetups, but it was still very, very dodgy back then. Found it fascinating. The first time I actually bought a Bitcoin was at one of those meetups. They were doing physical minted like sterling coins that had a QR code on it that was your private key. And so that's how I bought my first crypto, was through those kind of physically minted coins. And that was my Christmas gift for my siblings that Christmas. They all thought I was completely crazy and it was the worst gift I could ever have come up with. They're less upset today, but back then I realized it was so hard to explain what was Bitcoin and why that gift was actually cool. And trying to explain that, you basically have to, you know, in order to explain something to your mom, you have to understand it really well. And that was really the kind of thing that triggered me to understand really what is Bitcoin. And that it was in 2012, 2013 was the resources to actually learn about Bitcoin were very limited. And I actually did there was a MOOC, like an online class provided by Princeton on cryptocurrencies that was absolutely great. And that was kind of my first, experience down the rabbit hole of crypto. And I met Pascal Gauthier. He's the current CEO of Ledger, and he's the actual original founder of Kaiko. So I'm not the original founder. Pascal started the company in 2014 while I was still at HSBC, and he approached me because he was interested in getting my help to sell Kaiko's market data on Bitcoin to financial institutions, to which I responded, I think it's a bit early. I'm not sure banks are ready to acquire Bitcoin data right now. They actually don't want to have anything to do remotely close or far from crypto assets. It was a bit of the early days, but we stayed in close contact. And actually the product that Kaiko provides today is still the same that Pascal had envisioned in the early days in 2014, which is literally crypto asset market data for financial institutions. It's just that this specific market really came to life during the second half of 2020. So he was like 6-7 years too early, let's call it. On the other hand, you know, the fact that he was so early gave us an edge, which is when I left banking, and I basically acquired Kaiko from Pascal in 2017. When he joined Ledger, I took over Kaiko. And at that point, we already had something to sell when there started to be some form of enterprise institutional interest. It was more smaller crypto funds back then. There was no, kind of JP Morgan looking at crypto, much more the opposite. But there was starting to have a kind of B2B market for crypto data. So when I took over in 2017, it was the ICO craze, and we were able to start monetizing the existing data that we had, thanks to Pascal kind of he had been a bit forward thinking. So that's how we started. And in 2017, when I took over, we've hired the team that we have today, and we started raising. So we closed our seed round in early 2019, and we grew the team to about 20 people, centralized in Paris with offices in New York and Tokyo. That's kind of the story of how we went from banking to today to Kaiko.
And what does
awesome.
Kaiko? What does Kaiko mean? Do you know the origin behind the name?
Yeah, actually, the story is really cool, and I don't get asked that question a lot, so I love it. Thanks for asking. The original name of the company was called Challenger Deep. Challenger Deep, and the idea was we're going to go into uncharted territories, which is blockchain, in order to retrieve data. Challenger Deep is the deepest point under the ocean in the Mariana Trench. And that was really this notion of we're going to go where nobody has ever been, and we're going to bring you valuable data. Turns out Challenger Deep.fr is a terrible website URL. And so we started looking for a 5-letter .com name, and Kaiko is actually the name of a Japanese submarine, which was a scientific exploration down Challenger Deep, which brought back super valuable data that is still used today by scientists around kind of unexplored fauna down in the ocean. And so Kaiko is named after this submarine, which was the first successful exploration ever there.
I love that as a story. That's a great origin story for the name.
Awesome. Wow. So there's so many questions I want to ask and want to go in different directions. I want to talk more about Kaiko data and kind of crypto markets, but actually, something you mentioned in your story, I think is really interesting about kind of surviving, these kind of long troughs where crypto historically is kind of gone up, and then it's gone into these periods. And Kaiko is a survivor of some of these kind of downturns. And I just wanted to get your perspective on as an entrepreneur, operating lean and being prepared for shifts in the market. And also what you think is going to be the story going forward. Are we going to continue to see the same kind of crypto winters, or do you think it's going to be a less severe winter given the institutionalization of crypto?
Yeah. So actually, I think your last sentence really pointed out on the important word. It's really the institutionalization of the space. And you addressed that in your presentation about like there has been an acceleration of the market maturation over 2020. We, from a data perspective, have seen it not only through the data itself, like larger trades on average, et cetera, but also through the types of demands that we get. So we're seeing, all those new entrants in the space from an institutional, kind of traditional institutions, right, getting into the space, are actually coming to us for very interesting use cases that we hadn't seen as much in the past, which is valuation. Like the need for regulated entities to rely on third-party data that they can use in order to value assets post-trade is super important, right? In the past, we had a lot of people getting data for research purposes. They wanted to understand the space. Now we're in the kind of post-trade world where people need valuation data, and they only need valuation data because they are regulated entities, which really shows how structurally the market is different now. And so I don't think we will see crypto winters as we've seen in the past, just because like a bottleneck, I believe, has been passed. And the question of timing for this institutionalization of the market has been like my number one question from every single investor I spoke to in the past, especially during the seed round, right? Because our product is an API product. So it's completely B2B. There's no front end, there's no app, there's no terminal. It's just an API that is geared towards institutional investors. And so that specific market is at the same time huge once this bottleneck is passed, but has been very, very shallow in the past, just because that industry hadn't really make the move towards crypto. I think it's done now. And so to your question about staying lean during those bear markets, it's actually been really important. We're still a very small team compared to what we do. However, I also believe that now that this acceleration is happening, it's also the time to actually invest relatively heavily and start being a little bit less lean and a little bit more kind of, reactive and taking the wave while it's here. So we're going to accelerate. We're going to announce next week actually a dozen job postings across the board at Kaiko, and the team will probably double this year. But we've waited until kind of that point of tipping over towards the opening of this institutional market. So yeah.
Cool. Well, good chance to advertise to prospective recruits. Why come work at Kaiko? Give us your pitch.
Yeah. Listen, fast growing startup, super international team. We're based in Paris, but most of the engineering and product team is based in Paris. We have an office in New York as well from a kind of business development standpoint, because most of our market actually is in the US today. About 50% of our clients are in the US, 30% mostly like Switzerland, Nordics, and UK. And then the next kind of move from a biz dev standpoint is really to open up an office in probably Singapore and spin up operations in Asia. So fast growing startup, international, super cool team. Garrick, part of them. And yeah, I'll make sure to share the posts around all the job openings next week.
Yeah, I can definitely support people. If you don't come work for Blockchain.com, you should look at Kaiko next as your next possible but let's transition to crypto markets. And you guys have done some incredible work on trading data. You have some unique data, and you've done some incredible analysis. I'd love to hear kind of what's top of mind for you as you look at kind of the current market and the data landscape. What things are catching your attention, maybe around institutional activity, the traditional crypto retail firms versus kind of futures markets, and GBTC, and just whatever you want to talk about with the current market landscape.
Yeah, absolutely. So I think a couple of trends that all concur to what you presented early on is really I go back to that, but the transformation towards a much more institutional market, I think, is clear even from the data. If you look at like the average trade size, generally has increased. We've also seen something interesting looking at order books, and basically in the trade data, when you look at tick by tick trades, so down to the individual transaction level, you have a bunch of like metadata associated to every trade. And one of them is trade direction, which is, has this order been triggered by a buy or sell order? And what we've noticed is that generally you had a large buy order that was being filled by multiple smaller sell orders, kind of suggesting that you have smaller owners that were selling down while you had larger purchasers, or on the buy side you had larger order sizes. And so generally you had like one big buy order that was eating up in the order book and filled by multiple smaller sell orders. So that clearly indicates that, and on average larger trade sizes indicates just a bigger appetite from people that are building up larger positions. That's definitely one thing. The second thing is, in general, the rise of all the exchange traded products. So we are data provider to a couple of listed products on the European stock markets. And that is something we've seen a very strong increase in demand for. So index providers, exchanges, people that want to launch regulated products come to us to provide the data infrastructure piece. So we work with calculating agents that then build the methodology. This also shows a transformation. We wanted to be a part of that role, of that industry, for a long time. It just wasn't there. So that's an interesting shift. And then there's the valuation thing, which I think is super interesting, really from a demand. We presented actually to the SEC a couple of weeks ago an internal webinar around those specific use cases, which is we've built an entire offering around valuation. It's a problem for a lot of participants in the institutional space, not only investors, but also companies like audit companies. When you have to audit a crypto business, where on earth are you going to find the exchange rates in order to calculate the 31st of December kind of value of the company? There's all these use cases for answering the question, what is the price of Bitcoin? When you're, you know, the average Joe, you're fine with like an approximative price. When you're an audit company or when you're a regulated asset manager, you need to have a precise price and you need to know how it's been calculated and what was the methodology behind it. So that is, in my opinion, super important. And there's just one thing that I wanted to say when I was hearing you talk about the environmental question around energy consumption for Bitcoin. It's something that I've kind of formed a relatively strong stance on. I have a belief that blockchain will transform, like at core, how traditional financial markets function, in the sense that we're not talking about doing things faster like we have in the past 40 years of financial engineering. Here, it's not about marginally improving how we do things. It's about completely transforming the way money is sent, the way financial contracts are implemented. There's so much that we can do. And we see that happening a little bit in DeFi. For me, DeFi is a sandbox, you know, of what could happen in traditional capital markets. And that has no price. Like it sounds absurd to me to start quantifying the energy cost of something that is so essential to like just the survival of the functioning of the economy at scale. Like, I don't know how much the whole powering ATM all around the world costs. And honestly, I don't know that. And I don't know if anybody cares, because having an ATM next door is so important. The cost of, like, you know, the contactless payments, has anyone ever measured that? I don't think so. We don't question the price of lighting streets at night because it's so important. And for me, the revolution that is brought by blockchain as the technology and the kind of realization of that through Bitcoin and Bitcoin functioning for the past 12, 13 years now without ever being hacked is just priceless. That's it. And so I know it's a bit, you know, it's not very politically correct to say that, like, who cares about the environment? That's not what I say. I say that for something that is so game changer, we shouldn't be like counting at that stage.
Yeah, I'm glad you mentioned that. And I feel a little personally responsible for some of the direction this has taken. You know, I think, you know, I kind of helped get the Cambridge, you know, blockchain research program on the map when I started there in January 2016. And we did some early work there, kind of bringing the miners in to share data. And the index that's provided by Cambridge, you know, I think makes it really easy to kind of have a shock headline that, you know, the Bitcoin network is as big as XYZ country, without any of the context around, well, what are we comparing it to, and you know, and how complex. So this question came up in 2017 a lot when Bitcoin's price was, you know, breaking new ground. It's coming up again. It's something that's an incredibly complicated topic, but I 100% agree with you that it's too simplistic to try to, you know, bring it to, oh, you know, this thing's as big as XYZ country and that's a bad thing.
And, you know, I don't want to bring up what is the cost of streaming Netflix. I mean, honestly, like, what is the cost of, like, the luxury of seeing a stupid TV show, like, at night without mindlessly even, like, you know, listening to the content? Like, honestly, this is costing more than Bitcoin, and we're talking about a financial system. I find it very, I mean, not annoying. It's an important debate. And I think that debate has triggered, you know, the proof of stake change. I think is super important, which brings me to Ethereum. We focus a lot on Bitcoin and those kind of institutional discussions where in some way, like, Bitcoin is an incredible asset and it provides a real kind of, you know, proof that blockchain works, period. However, like, if we actually do move to proof of stake on Ethereum, all those financial applications that are being built, everything that is DeFi related actually lives on Ethereum. And this is kind of moving towards a more eco-friendly mining, you know, protocol. So there are things that are being done. Like, we're not going to just move everything, the entire, like, international digital finance to proof of work. That's not the problem. That's not really the point. And which also brings me, and then I'll stop commenting on what you said, but the transaction fee, like, if you see gold as, like, if you see Bitcoin as digital gold, I mean, it costs more than $27 to go and get your gold bar at the bank and move it to another safe, right? So again, like we're not going to pay Bitcoin with coffees with Bitcoin. That's fine. I think we need to accept that. I think there are other cryptocurrencies that will be used for day-to-day stuff that could or could not happen on layer 2s, etc. But the question is, like, Bitcoin by itself is an incredible proof that blockchain works incredibly well. It has its own narrative. It is, you know, store of value. It is this digital gold narrative now is very much accepted. But the transaction fees or the energy consumption, I don't think should be a big issue. And I think it's important to bring the narrative back around that and put it in context.
Yeah, great. So I want to talk more about your data. And, you know, for years, there was all this concern around the data that was self-reported by exchanges about their trading volume, and exchanges inflating their self-reported volume to try to make it appear they had more liquidity, more use than they really did for competitive or marketing reasons. Where are we at today with that issue and the quality of data? And how do you as a company kind of sift through, you know, what's being provided to you?
So we don't really take a stance, as in we don't ourselves filter out data or trades that we think may be fake volume. The position we've had was there is information that is visible to the market in real time, and it's our job to make that data as accessible easily as possible. So we really like provide all data that is perceived by the market in real time. However, we don't take a judgment on the data. We integrate all exchanges regardless. However, we do provide data to researchers in the space that are, you know, looking into that. Notably, the most famous report that was built around that using our data was the Bitwise report that identified those kind of real 10 exchanges that had, you know, seemingly very organic order book to trade data sets, and it made sense. What we see generally is that there's it seems, and honestly, like, I'm not the expert. Clara is the one who writes all of our research, and I've asked her, we talked about the questions, and so I asked her for her thoughts, and she's saying that, you know, the order books and the trades seems much more organic now, just in terms of how they correlate to again, these trades and order books, and understanding how orders match and then creates transactions. So that's one thing. And generally, I mean, the only way to understand really the space is to get your hands on raw, granular, tick-by-tick trades and tick-by-tick order books and do studies on that. This is what we provide. And we work with researchers, but we don't really ourselves take a judgment on that.
Awesome. So what's your price forecast for crypto? What's your feeling here? This is the question that we always get, like, and I'm just going to jump right to it. And I want to put you on the spot for a change. I'm sure you get this question all the time anyway. So you must have a great answer. I'm sure a better one than me. What is your price forecast? Are you worried? Or you think it's going a lot higher? How do you think about this question?
So I think it's going to go, first of all, I don't offer investment advice. Don't invest more than you can afford to lose, blah, blah, blah. But that being said, let's put it straight. I probably 90% of my savings are in crypto. So I'm super bullish on the industry in general. My personal allocation is like something like 50-50 Bitcoin, Ethereum, and very, very few others. It's really 50-50. And that is a bit by a natural move of proportions because of last year. Initially, it was more weighted towards Bitcoin, and with the kind of performance of Ethereum over the past 6 months, it actually rebalanced to about 50-50. I think there's a lot of upside. I'm a big defender. I obviously, like, Bitcoin was the first thing I ever bought when it comes to crypto, and I'm super bullish on Bitcoin in general, but I also think that ETH is always a bit underestimated and undervalued, especially by institutions, you know, and I think it's a question of understanding of the narrative, and the Bitcoin narrative is relatively accepted now as digital gold. But the question I get asked very often by people is, okay, I understand now that I don't need or have to understand how blockchain works in order to adhere to the whole narrative. It's like what you said about the internet, right? Like, honestly, I don't know how email works. I send emails every day. So that's the question I get. The question is, can you give me an example of a blockchain application? And in general, it always goes back to DeFi applications or something that lives on Ethereum. And so I find it funny that actually, when you think about usage, other than sending and receiving assets, it very often lives on Ethereum, and yet all the institutional demand is still only Bitcoin. And for me, the reason is that today we've accepted the investable asset class narrative, as in crypto is a new investable asset class. Bitcoin is the most known and understood. And that's now, is the current situation. I think the next situation, and the question is, when will that happen? I'm not yet sure, is the next understanding that blockchain is a platform that enables the digitization of products and services in the financial industry. And I think that will be the time of Ethereum. When will that come? I don't know, but very long term, I'm super bullish on both, but equally on Ethereum than I am on Bitcoin.
Yeah, that's really interesting. And we haven't talked much about DeFi, but I assume that you're quite bullish on kind of DeFi and what's happening around the Ethereum network and that really powering, the Ethereum token quite a bit higher from here. Yeah.
Absolutely. And so from a data perspective, it's interesting because we didn't integrate decentralized exchanges until last year. It wasn't really, we were not getting demand just because the sheer size of like trading volume on decentralized exchanges was not interesting for our audience, which is institutional investors. There was a kind of tipping point when there was one day on Uniswap where there was more traded volume than on Coinbase during that day, which was somewhere in, I think, September, October. And from then on, things started changing, right? And all the like DeFi, it's definitely not the large traditional financial institutions yet, but all the crypto funds, they're full on DeFi now. They actually have a lot of issues from a data perspective and valuation, just because it's really hard to understand with all the staking and the value locked in contracts, etc. Like, it's actually hard to value how much money you have. But so we've started now we run our Ethereum nodes and we are extracting still only market data. So we didn't go into the on-chain data play. We don't do stuff like, hash rates and mining difficulty and all of those metrics. We focus only on trades, but we extract those trades from Ethereum to get Uniswap market data. And we're adding more DeFi protocols now. So that's about reading from the blockchain and then providing this blockchain data on traditional APIs. So we're able now to provide Uniswap trades through a normal API. And then the other thing is about bringing traditional exchange data, centralized exchange data onto the blockchain. And so we're also, pulling from old crypto traditional centralized exchanges, but we're also able to write through oracles on chain. So we provide data that can be used in smart contracts. Notably, we work with Chainlink, where we write benchmark for about 13 different feeds. And we also provide Tezos exchange rates, where we write directly inside the blocks. We basically provide Tezos Bitcoin and Tezos dollar exchange rates. So it's really this on-ramp, off-ramp of data on and from the blockchain, bringing on-chain data to the real world and then bringing traditional data onto the blockchain. And I think as we add financial instruments and financial protocols onto the blockchain, as pretty much as DeFi grows, the provisioning of data on and off chain is going to be a super important component. And that's the infrastructure piece we're solving from. And that brings me to one question that is about on-chain data that you asked, and we haven't addressed it, is about what kind of on-chain data I would love to see on-chain. There's one thing that I believe is a huge problem from a data perspective in crypto land, and that is supply. Supply is, excuse my French, but it's a real shit show to get proper supply data. And I think it should be like some kind of accepted standard amongst the industry that when you launch a chain, you include supply data in your kind of block headers or something like that. Because it's really hard as a data provider. We get asked for market cap very often. And market cap is just the latest price multiplied by the supply. And supply, apart from like the algorithmic tokens such as Bitcoin, where it's clear, it's actually a very hard question. And I think that's an on-chain data metric that is missing in order to have proper market data that is clear and transparent.
Do you want to name any names?
No, I mean, take, you know, well, top 3, I mean, okay, we know for Bitcoin, we know for ETH, and then everything else is very, very often hard to get, pretty much. It's just like self-reported supply is, you know, you don't really differentiate circulating supply from the, you know, all those ICOs. You don't really know what's treasury tokens, what's out there, what's not out there, what's minted, what's not. So the self-reporting is weird. And if you look at supply across 3 different sources, you may have like orders of magnitudes difference between the different reported values. So I think it should be a really like an effort from the industry in general to provide transparency around supply. Yeah.
So just we're coming up on the end of our time here, but I have at least one more, maybe 2 more questions if we have time. I wanted to ask you, and this may take you back a bit to those early meetup days in London, which I'm sorry we didn't meet then. I went to my first crypto conference at the 2013 San Jose Bitcoin Foundation conference. And, you know, one of the things I noticed there, I'm curious if you saw this as well in those early meetups, it was very male dominated. You know, there were a few women at the conference, but it was, you know, mostly men. And I wanted to ask you your perspective on this, you know, kind of historical concern that crypto has been very male dominated. Has that changed? You know, I'd love to hear about your experience in your company.
So the feeling I have from, first of all, I come from a world that was absolutely male dominated, right? I come from like the trading floor environment. So compared to that, crypto is like very much of a normal place. So maybe I'm slightly biased in the answer I'm going to give, but for me, it has never been really an issue. And at Kaiko, like if you just remove the core engineering team, we have 50% women as part of the kind of my colleagues. And it's not that I've actively been looking for women. It's just like they were awesome and they were just great for their job that was offered. And so I just hired them. And perhaps it's also a bit driven by the fact that I, as a CEO and a female, kind of, it also organically attracts more women to the company. Maybe that's why, but I don't feel from my experience that I've had like a shortage of applications from women, or that I had like less, you know, suitable candidates that I hired anyway. Like this is really not the case. And then from the context of being part of this ecosystem, the feeling I have is really that nobody cares. It's like, as long as you bring value to the table by either your product, your service, your thoughts, whatever it is, as long as you provide with content and insights and value, people just like work with you or adhere or go out for beers or whatever. Like I've never really felt that as a problem. So yeah.
Awesome. Yeah. last question. I want to just reaffirm what Ombre said about Paris being an awesome place to live and work. I jump at every chance I get to go visit Paris. Love the jazz cafe scene there. But you know, Blockchain.com, you know, big London presence. You know, Brexit happened. You know, lots of concern about, is London going to slip as a tech hub? I'd just be curious about your perspective on the continent in Paris about kind of this, you know, landscape of, you know, emerging tech hubs. Silicon Valley, all these people are fleeing Silicon Valley. It's too expensive, too crowded, bad politics, et cetera. Is Paris rising, you know, relative to London and Berlin and even, you know, globally? Or what's your experience in France and in Paris?
So I didn't really have a, you know, startup experience before Kaiko, and I was in London before. For the record, I also cannot wait to jump on a Eurostar and come to London for a beer. So I think we all miss, like, you know, it's always greener on the other side of the fence. I haven't lived the startup scene in London. I've lived the kind of financial banking world in London and the startup scene in Paris. What I'm sure of is that the startup scene in Paris 10 years ago is nothing compared to what it is today. So it definitely evolved. How does that compare? Or is it, you know, quicker or slower than London? I don't really have a view. But what is true is that, like, at Kaiko right now, we've made a couple of really senior hires. From one of them, my head of growth, we've hired from Silicon Valley Bank and VMware. She was 10 years in San Francisco, and as you just said, she fled San Francisco and she joined Kaiko, which I thought was it's interesting that people who have a career in large corporations are happy to just quit and move to startups. So it means that, like, the startup ecosystem is becoming more and more attractive for those type of guys. And second, also our head of product, we've hired from Euronext, which is, as you know, the large European traditional exchange. And same thing, right? He made the move to a small 12 people startup in Paris. So I feel that it is attractive. Is it because Kaiko is such an incredible company, or is it because in general startups are more exciting? I would like to think both, but I haven't lived the London startup life.
Well, I don't know if Jason, you want to come in on the whole San Francisco. San Francisco's been taking a beating of late, and you want to defend SF, or?
I'll do it in 20 seconds. As you can see, I'm here in the Bay Area. I feel like we are very bearish in our tendencies as humans, and so as soon as things seem to be going wrong, I think our bearish tendencies sort of kick into overdrive. And so I'm long a lot of these cities. I'm long Silicon Valley. When they did a study recently of where postal addresses were changed from San Francisco and the Bay Area, they found that something like 75% of moves in the Bay Area are just into other places in the Bay Area. So there's definitely some amount of people who are leaving. But I think what I'm excited for is the rise of other places as startup hubs, because the ecosystem being global and providing more opportunity to more people and to be more decentralized kind of goes with the thesis of crypto. It goes with sort of I think our values as a company, and I'm very much bullish on it all being net good.
Awesome.
And so why don't we wrap it up there? I want to thank Ambre for your time. I know it's an evening in Paris, and I want to thank Garrick for always providing great insights. This was a great discussion, and we will be posting it on YouTube and to our podcast, hopefully later today, along with a published report authored by Garrick and a few others. So thank you all for joining us, and we will close it out with another Coldplay. So thank you, and feel free to log off.
Thank you.
Thanks, everyone. Thanks, Ambre. Bye.